Is there a free lunch in today's bond market? Today we're going to talk about what an inverted yield curve is, why you might think of it as a free lunch, and how to think about the yield curve as it goes back to normal. Okay, so what is an inverted yield curve in the first place? So when we think about the term inverted, let's talk about what a normal yield curve is. Well, a normal yield curve is, if you think about it, if I were to tie my money up for, let's say, 30 days or 90 days, not a very long period of time, the bond market is going to compensate me a certain interest rate. Well, if I were willing to lock my money up for a longer period of time, let's say 20, 30 years, typically in a normal yield curve, they're going to give me a higher interest rate. So a normal yield curve starts lower and then goes up over time. So I am anticipating a higher rate of return the longer I'm willing to lock my rate up. That is a normal yield curve. This is what we see most of the time. Well, today's environment, we have what's called an inverted yield curve, and it's going the opposite direction. So in the short term, again, that 30, 60, 90 days, interest rates are actually higher today than the 20 and 30-year bond rates. And so I'll give you an example. Right now, we're about mid-year in 2024. This is the current yield curve. As you'll notice, it's sloping down. So short-term rates are around 5.5. Long-term rates, 20, 30 years, are around 4.5. So I'm actually able to get a higher rate of return in the short term than I would be tying my money up for decades at a time. Now, why is this? Well, there's plenty of people arguing where rates should be on this yield curve, but the only reason that you would theoretically tie your money up for an extended period of time is if you thought those long-term rates were going to go down and you want to lock in the current rate. Okay, so if you like that 4.5% and you say, well, I just really want to lock that in for the next 20 or 30 years, that's why you might want to purchase those longer term bonds. Now, what are we talking about when I say why there might be a free lunch when it comes to bond investing or a safe place to put your capital? Well, again, typically the yield curve is upward sloping, which means to get a higher interest rate, you have to accept interest rate risk. So you have to tie your money up for longer, 10, 20, 30 years in order to get those higher interest rates, which can be a challenge is if interest rates go up in the marketplace and you are holding a bond that is at a lower interest rate, the value of your bond drops. And so it's probably pretty fresh on your mind when you looked at the bond markets over the last couple of years. Long-term bonds in value have been dropping dramatically. Why is that? Because interest rates have been ticking up. Currently, on the long term, they sit around that 4.5%. So if interest rates continue to go up, the value of those bonds will continue to go down. And so this free lunch is, well, currently you're not getting paid to take that risk. You're actually going to get paid more by taking no interest rate risk and sitting in shorter term bonds or shorter term money. So anywhere between 0 days and a year, you're getting paid around 5.5%. To move over to the right side of the graph, not only are you accepting a lower interest rate, but you are exposing yourself to potentially double-digit losses if rates continue to go up. So we say, okay, well, looking at this yield curve, that makes sense. It's inverted. I kind of get this free lunch because I can put my money in the short term and not have to worry about rates going up, which means if rates go up in the long term, the value of those long-term bonds go down. I don't have to take that risk. That's great. Keep in mind, again, the reason that you would buy these longer term bonds, because I have clients ask me all the time, why would anyone buy the long-term bond? Take the free lunch. You do the short-term bonds. It's higher rates with no risk. Well, if you're worried about those long-term bonds going down interest rates, well, right now they're in 4.5. If you think they're going to go to 4 or 3.5, something like that, it's not impossible. But I will tell you, if you look at history, it's not incredibly likely. But if that is the future expectation that you have, then that's something that you should consider. So currently rates are inverted, or the curve is inverted. What does it look like for the curve to go back to normal? Right? And the reason that that's important is to think about eventually the curve is probably going to go back to normal because it always has. What might that mean for where we should be on this yield curve? Short term, long term, what's it going to look like? Now, while the future is unknown, that's why they call it the future, two things can really happen to go back to a normal yield curve, which means short term rates are lower, long term rates are higher, right? Upward sloping. There's two ways this can happen. Either short term rates can start coming way down. So they can go from 5.5 and they'd have to drop below the long-term rate, which is around 4.5. So short-term rates drop from 5.5 to 5 to 4.5, and then maybe they drop to 4. And so if that were to drop, what you'd have is a regular yield curve, which means short-term rates are lower, long-term rates are higher. Okay, that's one way that you could go back to a normal yield curve. What's another way that it could happen that I think many investors are discounting? Another way that the rate or that the yield curve can go back to its normal slope, which is low to high, is long-term rates could continue to rise. So let's say short-term rates stay around 5 and long-term rates start to go up above 5 to 5.5 to 6, right? And some people say, wow, that seems like that would be crazy. Except if you look at history, that is not crazy at all. A 5.5%, 6% long-term interest rate is not wild. That's pretty normal. In particular, when you're dealing with mortgage rates, 7-ish%, a 6% long-term government rate is not that wild. And if that were the situation and that were to happen, and you owned long-term bonds, that is losses in your portfolio when you look at the value on your statement. The value of those bonds goes down as interest rates go up for long-term bonds. And so the free lunch here is you don't need to take that risk. Most of the time, when it comes to investing, you need to take risk to get a higher rate of return. Turns out in the bond market, that is not the case. You can get a higher rate of return in less risk. Now, you only risk, and I would air quote here, the only risk that you are taking not buying long-term bonds is the risk that long-term bond yields go down and you didn't lock in that yield. Right now they're around 4.5. How much lower do you think they could possibly go? I don't know. Could they go up? And if they do, how high could they go? We've looked at history. We've seen them double digits. Who knows where it's going to go? But that is all risk that you do not need to take in your portfolio. And if you are, at least make sure it's a calculated risk. Make sure you know that you're taking that risk. And so when you look at your investments, when you look at your portfolio, pay particular attention to your bond holdings. If it's some kind of broad market bond fund, you most likely own some of these long-term bonds, which means that is the bet you are making. Instead of being short-term and not taking any risk and taking the higher rate, you are actually saying, okay, I'm going to be in this longer-term, lower interest rate bond, and the only way that I win in this bet is if those rates go down. If they stay the same, I would have been better in short-term. If they go up, the value of that investment can potentially lose money. And so, more than anything, look at your portfolio, understand what's in it, and as I always say, know what you own and know why you own it. I hope you found this helpful, and as always, thanks for investing your time with the Personal CFO.